Global Management Chief Economist Torsten Slok joins us now. Torsten, what do you mean? Are things a lot tighter than we're thinking that they are?
Well, that's a very important question, Sarah. But the Fed has this calculation where they say it's not only about the Fed funds rate, and it is also about the other tools that they have in the toolbox, most importantly about balance sheet policy and about forward guidance. Remember, those were new tools that they introduced after the financial crisis in 2008. We never really had the balance sheet or forward guidance playing the major significant role that it does today. And when you quantify the impact, in particular, of course, the balance sheet of running down the balance sheet as they're doing at the moment, they do find in their own calculations that the Fed funds rate today is not only 5.5, but it's actually 7. In other words, policy is a lot tighter than what they and we all think, simply because the other tools that they have are also helping in putting downward pressure on the economy.
And yet, the economy is hanging in there quite nicely.
That's right.
And a lot of the data recently has come in better. And even though Powell was kind of neutral when he spoke last week, he said there's evidence that it might not be tight enough.
I know it is, honestly, quite incredible how resilient the U.S. economy is. There are signs for the consumer. We are seeing delinquency rates going up on credit cards, delinquency rates going up on auto loans. For firms, we're seeing default rates going up for high yield quite quickly in the last 6 months. And finally, for banks, we're also seeing bank lending in the weekly data slowing down. So consumers, banks, and firms are beginning to see more and more impact of the Fed hiking rates, but it still has to bite harder and harder on those 3 different fronts, and including the data we just got this morning on new home sales. It is quite surprising also how resilient the housing market is, because we're still having quite a headwind. We continue to talk, all of us, about rates being so high. So we still have to wait a little while longer, but it will ultimately happen that we will begin to see a slowdown. That's what the Fed needs to get inflation down to the 2% target. Remember, core CPI today is 4.1. So we're still not there yet before the Fed, they can begin to take it more easy. They still need to be hawkish.
Yeah, we'll get the PCE deflator on Friday. Torsten, I think the other sort of silver lining to all of this is that if we do go into recession or we do face more increasing economic pain, they've got tools. We've got interest rates that are not zero anymore. We've got a balance sheet that has shrunk more than $1 trillion. They have levers to pull, whereas they haven't in the last 10 years or so.
That's a very, very important point for markets. Think about this recession that we're also worried about, and that is likely, in my view, coming on the horizon. This is something, the slowdown that we are talking about here is engineered by the Fed. This is manufactured by the Fed. The Fed is trying to slow the economy down, to slow inflation down. This is not like the previous recession. Of course, it's not like the pandemic that came literally out of the blue. It's not like in 2008, where there was a huge imbalance in the housing market, in the banking sector, on consumer balance sheets. It took time to clean up after those imbalances. Likewise, if you go back to the previous recession, which was the tech bubble, it also took time to clean up after the tech bubble. But here today, this is all engineered by the Fed, this slowdown. So if things start to slow as they want, they will begin to turn around, and therefore the slowdown is probably going to be milder than what we have seen in prior recessions.